Hello and welcome back to another video on the ComLucro channel. Today we are going to break down the market's core algorithm, the Interbank Price Delivery Algorithm, one of the most important foundations for understanding how institutional price delivery truly unfolds inside market structure. In this chapter of our Smart Money Concept series, you will learn how the algorithm works, how to recognize its behavior across different market conditions, and why smart money uses it to manipulate price in a controlled and algorithmic way. You will also see how understanding this mechanism helps you anticipate future movement, avoid common retail traps, and align yourself with the flow that drives institutional decision-making. We will also walk through the 3 key market analysis tools from the IPDA framework that every trader needs to master before sitting behind the charts, giving you the clarity and confidence needed to interpret price action with precision. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Let us begin by laying the foundation. Before we explore the 3 main market analysis tools that every trader needs to master, we need to clarify what the market's underlying algorithm actually is. A specific algorithm shapes major market movements, and smart money, including market makers, banks, and large financial institutions, relies on it to guide price in their favor. This algorithm is known as the Interbank Price Delivery Algorithm, or IPDA. The Interbank Price Delivery Algorithm explains how smart money moves prices in a controlled and systematic way to seek liquidity, correct inefficiencies, and deliver price efficiently across the interbank environment. Knowing how this algorithm operates and how it behaves in real time gives you a clear advantage when anticipating future price movement. With that in mind, let us take a closer look at the Interbank Price Delivery Algorithm. IPDA delivers price efficiently to buyers and sellers in the marketplace, allowing price to move smoothly between buying and selling while offering prices in both directions. This reflects a broader efficiency paradigm within the algorithm's logic, where the market constantly shifts between buy-side and sell-side to maintain balance. There are 2 primary ways IPDA achieves this: rebalancing inefficient price action and seeking liquidity. Now let us break down what each of these means in detail. The first way that IPDA operates is by rebalancing inefficient price action. In this example, we can see inefficient movement created by this large bearish candle. Because there were not enough buy orders in that specific area and at that moment, the price dropped with strong sell-side momentum and provided no buy-side delivery. This behavior is known as sell-side price displacement. To correct this, IPDA later provides buy-side delivery to fill and rebalance that sell-side inefficiency. The algorithm often produces inefficient movement and temporary disequilibrium in the market, where price travels in an imbalanced way. The market then works to resolve these inefficiencies by returning to those areas, filling the gaps, and restoring equilibrium. This ongoing cycle of imbalance and rebalancing is a core characteristic of price movement, creating opportunities for traders who recognize these inefficiencies and anticipate the rebalancing process. The second method is seeking liquidity, also known as the pairing of orders. Here we have an example to illustrate how the algorithm searches for liquidity in the market. As you can see, price has formed a range, and there is strong sell-side and buy-side liquidity, both below and above this structure, created by clusters of buy-stop and sell-stop orders. We can observe that price moved sideways inside the range, until the algorithm began manipulating the market by pushing price outside of it. This often occurs during a news event or during a session open. When buy stops are triggered, the market experiences a burst of buying interest, creating a bullish move. After activating those buy stops, the algorithm shifts direction, driving price downward and distributing that buy-side liquidity toward the sell stops positioned below the range. Once the price sweeps the sell-side liquidity, The sell stops below the range pair with buy orders, and price then pushes upward toward the buy stops above the latest swing high. Then, the buy stops above that high pair with sell orders and are distributed back down toward the sell stops. The algorithm repeats this cycle continuously, engineering and regenerating liquidity throughout the market. It does this to make manipulation easier, absorb more liquidity, and fulfill large institutional orders. Understanding how this algorithm works will help you protect your assets in the market. Here is how traders use IPDA to do that. They identify zones where institutional traders are likely to take action, anticipate liquidity grabs around important levels, such as support and resistance, spot manipulation patterns, especially during session opens or major news events, and wait for inefficiencies to be filled as part of price delivery. So we have fully discussed the Interbank Price Delivery Algorithm and now understand the main algorithm that drives the market. In the next part of this video, we will explore the essential foundational concepts behind inefficient price delivery. These principles are crucial for mastering and truly understanding the Interbank Price Delivery Algorithm. Let us begin with the fair value gap, the most widely used and accessible tool within IPDA. A fair value gap appears on the chart whenever price delivers inefficiently. This occurs when price moves rapidly in a single direction. That rapid movement leaves behind liquidity voids and unstable price action that the algorithm will later attempt to rebalance and fill. Fair value gaps usually form within a 3-candle sequence and are easy to spot on the chart as a prominent candle. The key characteristic is that the upper and lower wicks of the surrounding candles do not fully overlap the body of the middle candle. This creates what we call the fair value gap zone, which occupies the space between the wicks and is drawn based on the middle candle. When the algorithm is in a hurry to reach a specific price point, smart money steps into the market and executes a large volume of orders within a short period of time. This creates an uneven distribution between buying and selling orders, producing displacement in price action that appears as a fair value gap. For instance, when bullish fair value gaps form, the space between the candles that fail to overlap shows a shortage of sellers compared to buyers. In other words, there were not enough sell orders to absorb the executed buy orders at that price level, leaving unbalanced buy-side activity in that zone due to the lack of sellers. On the other hand, when a bearish fair value gap appears, it indicates that buy orders were not sufficient to fill the executed sell orders at that moment, leaving unfilled sell orders in that area. These leftover orders are the reason price often returns to these zones and reacts in the opposite direction. From the IPDA viewpoint, fair value gaps fall into 2 distinct models. The first one is BC. BC describes a market condition defined by a buy-side imbalance and sell-side inefficiency. In this case, price delivers only to the buy side in a single direction. The algorithm drives price upward too quickly to provide any sell-side delivery and searches for more liquidity to consume supply and rebalance the newly formed demand. This produces a fair value gap known as BC. The algorithm later aims to correct the inefficiency by offering sell-side delivery, often forming a bearish candle that allows sellers to enter the market and restores efficient price action. The next type of fair value gap, the bearish one, is known as CB, which represents sell-side imbalance and buy-side inefficiency. This is similar to BC, but in reverse. In a CB scenario, the price moves sharply downward without enough buy orders to balance the movement, creating an imbalance. The algorithm then works to correct this by offering buy-side delivery to fill in the sell-side inefficiency, just as it does with buy-side inefficiency. There are 3 key levels inside the fair value gap that are important to us. We have premium, which is the high, discount, which is the low, and the midpoint, which is called consequent encroachment. Consider that each level also acts as a strong support or resistance level in the lower time frame. Now, let us move on to the next concept, mitigation block. A mitigation block is an area referred to in IPDA price manipulation logic. It refers to a specific area on a price chart where institutional traders or smart money have previously placed orders, leading to a price balance or a sharp move. The algorithm will refer back to this area to allow interbank level traders to mitigate their long or short positions in the market. The main purpose of a mitigation block is to revisit this area and fill any unexecuted or pending orders that were left behind during the initial move. In a bearish scenario, a mitigation block is identified by locating the last down close candle or a series of successive selling candles that form before an impulsive bullish expansion that fails to create a new higher high. This area represents a bearish mitigation block. The key characteristics to look for are a bullish expansion move where the price moves upward but fails to create a higher high, forming a lower high instead, followed by an immediate reversal. After the bullish expansion, price should reverse and break below the low of the mitigation block. The exact opposite applies in the bullish scenario. Now let us look at an example of a bearish mitigation block. Imagine the market is in a downtrend. To identify a valid bearish mitigation block, the first step is to look for a swing high to form. Next, we need to see a swing low. After this, the price must create a lower high with an impulsive bullish expansion. What we need to see next is an immediate reversal, followed by a market structure shift that breaks and closes below the latest swing low. At this point, the last selling candles formed before the bullish expansion represent the bearish mitigation block. Eventually, we see price return to the mitigation block again, adding more orders into the market, and then price moves lower with strong momentum. Now let us move on to the next concept, order block. Order blocks are zones on price charts where significant institutional order flow is likely to have been executed. They are known as decisional areas that form before a strong institutional move takes place in the market. Usually, price returns to these zones and often reacts or reverses in the opposite direction. In a bullish scenario, a candlestick-based order block refers to the last selling candle before price starts pushing upward drastically. This candle typically breaks below or effectively sweeps the liquidity of the lowest point of the previous candle. For example, in the bullish diagram, we identify this red candle as a valid order block. It serves as the last bearish candle before price initiates a drastic upward movement, having taken out the lowest point of the previous bearish candle and effectively swept its liquidity. Similarly, in a bearish scenario, a candlestick-based order block refers to the last buying candle before price starts pushing downward drastically. This candle typically breaks above or effectively sweeps the liquidity of the highest point of the previous candle. Please note that IPDA will refer back to order blocks to mitigate and add positions. Now let us see some of the most fundamental criteria and rules that we need to consider to identify valid order blocks. To have a confirmed and valid order block, first, the price must remove and sweep the liquidity above or below the previous candle to form a valid order block. Secondly, price must leave inefficiency behind and generate imbalance near the order block area. If there is no proper imbalance between the subsequent candles, then the identified order block cannot be considered valid. To solidify our understanding of order blocks, let us examine more examples. Consider a series of bullish candles as illustrated. As you can see, the market momentum was bearish until price created this weak bullish candle just before starting to push upward with these three large green candles. This weak bullish candle reached its lowest point here, and it also took out and effectively swept the liquidity below the previous candle. As mentioned earlier, our identified order block cannot be considered valid without a proper imbalance in the subsequent candles that form after the order block. If we look at this three-candle sequence, we see that the upper wick of the first candle and the lower wick of the third candle do not overlap the whole body of the middle candle. Here we have a gap between the candles representing the imbalance. Since the criteria for a valid order block are met here, this candle represents a valid order block. If we look a bit higher, we see that price has created a drastic upward movement once again. This red candle represents the last bearish candle that formed before price started to push drastically to the upside. We can see that this bearish candle has taken out and effectively swept the liquidity below the previous bearish candle. Since price has also created a proper gap between these three sequential candles, meeting all the criteria for identifying a valid order block, we can now consider this candle a valid order block with the potential to reverse price if it pulls back and mitigates it. As you can see, this bearish candle here is the last bearish candle before price formed another bullish movement. However, this candle does not represent a valid order block because it did not take out the previous candle's low. Let us examine more examples. Consider another series of candles, as illustrated in the second diagram. Once again, we see that price has taken the previous candle's low, effectively sweeping liquidity below it with this bearish inverted hammer candle. Thus, we have a potential candidate for a valid order block. However, there is no noticeable imbalance among these three candles, and the upper wick of the bullish candle mitigates the order block. Consequently, this order block cannot be considered valid, as it fails to meet the necessary criteria for validation, and therefore it cannot be used as a demand zone. When faced with scenarios like this, where price has taken out the liquidity from the previous candle, but the order block is mitigated, or when price fails to create inefficiency, we designate the subsequent candlestick as the valid order block. In this case, we identify this bullish candle as the valid order block instead of the previous selling candle. This decision is based on the fact that price generated a proper inefficiency or imbalance immediately following the bullish candle. If we look slightly higher, we notice that price has taken the previous candle's low, effectively sweeping liquidity below it with this bullish candle before price starts to push significantly higher. However, there is no discernible imbalance, and the upper wick of the candle mitigates this order block. Therefore, this order block cannot be regarded as valid and cannot be utilized as a demand area. Once again, price has pushed significantly to the upside. This red candle represents the latest bearish candle that formed before price started to push dramatically higher. Evidently, this bearish candle has surpassed and effectively swept the liquidity below the previous bullish candle. As price has created a proper gap between these three sequential candles and there is no mitigation, all the criteria for identifying a valid order block have been met. Consequently, we can now regard this candle as a valid order block. Before we wrap up, take a moment to reflect on why understanding these IPDA concepts truly matters. Tools like inefficiency, liquidity, mitigation blocks, and order blocks are not powerful only because of the technical details. They matter because they shape the way you interpret price and make decisions under pressure. The more clearly you understand how the algorithm delivers price, the easier it becomes to stay patient, wait for your levels, and execute without hesitation. But technical knowledge alone is not enough. To apply these concepts consistently, you also need the emotional stability that supports disciplined execution. That's why, before we finish, we are going to show you a short clip from our Psychology Mindset Workout for Traders series. In this segment, you will learn a technique called impulse interruption breathing, a simple tool that helps you break emotional spikes and regain clarity in moments when the market tests your discipline. Let us take a look. This video is part of our series, Psychology Mindset Workout for Traders, and today we are focusing on a technique called impulse interruption breathing. This method is supported by research in neuroscience and stress regulation. Studies from Stanford University and the University of Wisconsin show that slow, controlled exhalations activate the parasympathetic nervous system. This system is responsible for lowering stress, reducing cortisol levels, and restoring mental clarity. In simple terms, your breath can send a physical message to your brain that the situation is safe, even when your emotions feel intense. This technique matters because trading pressure builds fast. A sudden candle spike, a missed entry, or a fast move against your position can trigger an automatic stress response in less than half a second. When this happens, your amygdala, the emotional center of your brain, becomes more active and pushes you toward impulsive reactions. Slow breathing interrupts that process. It shifts activity back to the prefrontal cortex, the part of the brain responsible for logic, risk assessment, and good decision-making. That is why this drill is so effective. it gives you enough calm to act with clarity instead of emotion. That clip is a powerful reminder that consistency comes from emotional control, not prediction. The traders who stay calm, interrupt impulsive reactions, and remain aligned with their plan are the ones who turn these IPDA concepts into real, consistent performance. If this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.